Hey guys, it's Professor Moss, and so today I'm going to give you a quick overview of Chapter 11. 11, 12, 13 are, to me, some of the most important chapters we're going to be dealing with because this is what you're going to build your future on. This is investing. This is what you've got to know. You've got to be clear on portfolios and IRAs and different things like that. But in Chapter 11, we're going to talk about preparing for your investment program, what you need to do. What are some of your goals, different things like that. We're going to look at what factors affect your choice of investments. Not everybody is going to invest exactly the same way. So don't think that everybody's going to be thrown in the same pot. It's on whether you are a conservative investor, whether you are a high-risk investor. Then we're going to look at what are some things that will help you reduce your investment risk, because it doesn't matter what you invest in, there are investment risks. Then we're moving into bonds, and that's what this chapter at the end is going to focus on, the different types of bonds. We'll talk about government bonds, city bonds, county bonds, different things like that. We will move on to corporate bonds, and then we're going to look at how you know when's the right time to buy and sell bonds. So I have embedded a lot of videos in this chapter because investment changes as our economies has its ups and downs. There's some different things that you need to be aware of. So enjoy this chapter, make notes, keep notes, because this again is what you want to build your retirement accounts on. We're going to start out looking at how we establish investment goals. And you remember way back in Chapter 1 where we talked about SMART goals. We are going to apply those exact same characteristics to our financial goals. They are to be specific, measurable, action-oriented, realistic, and time-based. So you want to always remember that investment goals are always oriented to the future. You are investing for your future, your retirement, your children's education. You may be 19 years old and none of that's even crossed your mind, but you need to think long term. The first thing that you want to do is you want to do a financial checkup. You want to look, am I paying my bills on time? Is my budget balanced? And then you want to make sure that you're paying your credit card debt. You want to pay it in full each month. You don't want to use any credit for small purchases or having to get cash advance. Don't be one of these people that have 10 credit cards. I would keep it to 1 or 2. And then if you do find yourself in financial difficulty, you want to get some help. You want to make sure that you start an emergency fund that you can access quickly. 3 months of living expenses. And you want to have access to other sources for cash emergencies. Let's look at factors that reduce investment risk. We're first going to talk about asset allocation and diversification. When I say asset allocation, I mean that's the process of spreading all my investments among several different types of investments. I know you probably heard the old term, we don't want to put all our eggs in one basket, so that if our basket breaks, we lose everything. That's what asset allocation is. You also want to look at diversification. That means I'm going to have stocks, I'm going to have bonds, I'm going to have risk-free assets, possibly real estate, and then if I'm real high risk, I might even invest in some foreign stocks. And you notice up here, I have on here that stocks, there's been about a 10% growth since 1926. That may be a little less today, but it's an average of 8 to 10%. So talking about preparing for your investment program, why should you begin now? Because the sooner you start investing, the more time your investments have to work for you. And There's going to be ups and downs in the stock market, and you're not going to have to panic. If you wait till you're 45, you're going to see a big difference in how much money you're going to make. In chapter 12 and 13, we'll show you what the difference is in the time of working. And then you also want to have some specific goals you want to accomplish, and they have to be the driving force behind your plan. Back to those SMART goals, the specific and measurable. Some say start goals in terms of money, others say start it by the particular things that you desire: retirement, a retirement home, your children's college education. This slide just gives you some investment goals. How much money do you need for that goal? How much risk are you willing to assume? What do you think could be some possible economic or personal conditions that would affect your goals? Considering your economic circumstances, how long can your investments work for you? And are you willing to make sacrifices that are necessary to ensure that you meet those goals? Now remember, way back in chapter 1, we talked about opportunity cost. What are you willing to give up in order to get something? That's what that's talking about. The next slide is a Dave Ramsey slide, and this is kind of geared to more of the 19, 20-year-olds that are in the class, how you should start investing as a young person. Exhibit 11.1 just gives you some ways that you can accumulate the money that you need to start your investments. Pay your bills, then pay yourself. If you work for someone that has an employer-sponsored retirement program, please take advantage of that. That's, to me, is one of the most important things you can do. Participate in an elective savings plan where you have so much taken out each payday and put either into a savings account or a 401 account. Make a special saving effort one or 2 months a year. A lot of people will, when they get their tax refund, they'll go out and just buy something because they've gotten a refund. No, 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 no. Take that money and invest it. Put it in an emergency fund. Then take advantage of gifts, inheritances, and windfall. So this is, to me, one of the most important slides in our presentation because it's talking about how time value of money is going to affect your investments. A lot of people never start an investment program because they think, oh, I only have just $1,000 to put in to an investment. But what you have to think about is that even those small sums of money are going to grow over a period of time. One thing you want to do is you want to notice that the value of your investments are going to increase each year because of 2 factors. It is assumed you're going to continue to invest or deposit money in your investment program. So even if you're putting $1,000 every year into it, it's going to be increasing. And then your investment earnings are allowed to accumulate, and they're added to your investment deposits. One other thing is you want to know that investments earn a higher rate of return than your portfolio values are going to increase. So that's when you want to think about those. But you want to know that the longer your money can work for you and earn that interest or dividends, or the stock values appreciate, the more that your investment will be worth. So that when you retire at 65 or 70 or even 75, you're going to have enough money to enjoy life. You're not going to have to work a part-time job to be able to buy groceries. So the next slide is a video I want you to watch talking about time value. Although each investor may have individual reasons for investing, there are going to be some factors that all investors need to consider. One of them that we're going to talk about on this slide is safety and risk. And when we're saying risk, we're talking about the uncertainty about what the outcome is going to be. You're not ever going to know 100% what the outcome of your investment is going to be. When we talk about safety, we're looking at the minimal risk of loss that you are taking. And then risk, again, is going to be the return trade-off. I've got this in red because this is something I want you to really think about. The potential return on any investment should be directly related to the risk the investor assumes. So that's very, very important. Speculative investments are those investments that are considered very high risk, and they're made by those people that are seeking a large profit in a short period of time. But you got to be willing to take that risk if you're going to do that. Over here on the other side, there is a short video. It's probably less than a minute, maybe a minute and a half, and it's just talking about some other types of risks. So if you'll just click here, you'll be able to hear the that video. Here are some other parts of components of the risk factor. Inflation risk. During periods of high inflation, your investments may not have the return that they had previously. Interest rate risk, and it's the value of bonds or preferred stocks, and they may increase or decrease with the change in the interest rate. Business failure risk affects stocks and corporate bonds and causes the business to be less profitable than they were originally anticipating, and is generally due to bad management or unsuccessful products. And then you also have the market risk, and that's the risk of being in the market versus a risk-free assets. Deals with fluctuation in the economy from a period of rapid expansions that are followed by a period of recession. That is considered a market risk. Liquidity and factors that reduce investment risk are things that you need to think about. Liquidity is the ability to buy or sell an investment quickly. That's your key word, without substantially affecting the investment's value. Liquidity investments range from near cash investments to frozen investments, which are virtually impossible to get your money quickly. Interest-bearing checking accounts and savings accounts are considered very liquid because I can walk into a bank and I can get them. CDs impose penalties for withdrawing money before the maturity date, so those would not be considered a very liquid asset. Keep in mind that for almost 100 years, stocks have returned an average return of less than 10% a year. These returns are not guaranteed, and there have been and there will always be some years where you're going to have negative returns. What you have to remember is you are in it for long term. Don't panic when you see your investments going down one year. The long-term average return for stock market is well ahead of inflation and the return on bonds, real estate savings accounts, or CD. Before you go out and start purchasing stock, look at how your asset allocations can help you create that balanced portfolio. Remember, we told you we want to make sure it's balanced, and then that's going to help you risk your investment or reduce the risk in your investment program. The next section is talking about asset allocation and diversification. Earlier in the chapter, we examined how the factors of safety, risk, income growth, and liquidity affect your investment choices. So now let's go back and compare the factors that affect the choice of investments with some typical investment alternatives. Other factors include your time, how much you have for investment, your age, and we'll look at those as we go through this part of the chapter. Asset allocation is the process of spreading your assets among several different investments in order to lessen your risk. Again, I use this in the beginning. We don't put all our eggs in one basket. Asset allocation is often expressed in percentages. What percent of my assets do I want for stocks, mutual funds, real estate, bonds, or CDs? Diversification means I'm spreading it out. Provided by investing in different investments gives you a measure of safety, and then that reduces the risk because a loss in one area would be offset by gains in the others. Now, one thing you need to think about is the percentage of your investment should be invested in each asset to be determined by your age. The younger you are, the longer you have to make money, and the more riskier you can be. What is your investment objective? Retirement, your children's education, buying a retirement home, whatever it is. How much can you save and invest each year? What is the dollar value of what you have current investments in? And what are the economic outlooks for the economy? Some other investments are going to be a time factor. One thing that you want to think about is how much time do you have for investment? The younger your age, then those people are going to invest in growth oriented because they're going to go for those risky stocks that's going to pay them more. But the older investors are going to be a little more conservative because they don't want to lose what money they have put into the stock market. You will play a role in the investment process. You need to know where your money's going. So the first thing is you want to evaluate potential investments. Look at the time required. You want to make sure you've got the time to sit down and do your research. Look at the alternatives that you can make informed decisions. Talk to other people. Talk to your friends, your family. Use the internet. Monitor your investments. Some people use Excel and make a chart and watch how their investments are growing, or if you see a trend where they're completely falling apart, then you might want to sell them. Make sure you keep accurate records. One of the things you can do is to have a financial planner. In the beginning, it may be that you can do it on your own, but as you get to an older age and you have more investments, then you may need to seek the guidance of a professional planner. Exhibit 11.5 just shows you kind of what you're looking at when you're thinking about risk and safety and income and growth. So this is the level pyramid, and level 1 is you're just looking for financial security and you would want to invest cash, CDs, different things like that. Level 2 is safety and income, and that's some of your bonds and conservative mutual funds. Level 3 is growth stocks, mutual funds, rental property. And then level 4 is when you're going into the speculative stocks and high risk investments. The next slide is a video on bonds. We're moving into the next area in our chapter, and it's talking about the different types of bonds. So this section, again, we're going to be talking about bonds, and there's a psychology for investing in bonds. Investors often consider government or corporate bonds to be a little bit safer investment compared to stocks, mutual funds, or some other investments. They use the bonds as a way of diversification in their asset allocations for their investment portfolios. A government bond is a pledge from the government or a municipality, which is a county or a city, to repay that specified amount of money along with interest. U.S. government bonds are backed by the U.S. government, and they do carry a decreased risk of default. If our government goes into default, we're in a boatload of trouble. Bonds can be held until maturity, or they can be sold before maturity. You can buy them directly through the government. You can also get them through some banks will sell them. So this is a great way to start investing, is to buy these bonds because they are very secure most of the time. So, you know, it's just a way to start. You could actually start putting up bonds for your kids' education if you would like to. Um, there are four principal types of security issued by the government. They have to be bought with a minimum of $100. You have treasury bills, treasury notes, treasury bonds, and what is called TIPS, or treasury inflated protected securities. Now, one of the most important things about government bonds is that the interest paid on a U.S. government bond is taxable for federal income tax, but they are exempt from state and local taxation. So this is, again, a great way to start your investing. And now we have the state and local bonds. A municipal bond is a debt security, and again, that's by a state or a local government, state or a county. And again, they're used to finance ongoing activities for most of the ones we hear about are schools, sometimes toll bridges. You can again purchase them from the government entity that's issuing them. Then you have state and local securities, and they are the general obligation bond, again, backed by full credit of that issuing government. A revenue bond is repaid from income generated by the project it is designed to finance. When I thought about this, I thought about oh gosh, it's been 10 years when they had the toll road over by Lenox Square. That was a revenue bond. They raised the money. Once it was paid off, then they didn't collect any more. It was Georgia 400. Now it was a different toll road number. And once it was paid off, then they stopped collecting for that. So let's look at some corporate bonds. A corporate bond is a corporation's written pledge to repay a specific amount of money with interest. So generally these are going to be $1,000 bond, and then between the time of the purchase and the maturity date, the corporation is going to pay interest to the bondholder. So you have to think about, okay, I'm going to give them $1,000, and whenever it matures, then all the interest is going to come to me. You also have a maturity date, and that's the date in which the corporation agrees to repay the borrowed money. It can be anywhere from 1 to 30 years. You also have a bond indenture, and that's the document that details all the conditions. And then you have a trustee, and that's the financial firm that acts as the bondholder's representative. So why do corporations sell bonds? Do they not get all the money they need from whatever their items they're selling? Bonds are going to be referred to as the workhorse of a corporate finance, and really what they're selling them for is it's debt financing to finance ongoing business activities, or sometimes when it's really difficult to sell stock. It also improves the corporation's financial leverage. And then one of the biggest reasons they're going to sell bonds is it reduces taxes that the corporation has to pay to the federal and state government. Again, corporate bonds are a form of debt financing. Interest payments on bonds are required, and the bond owner must be repaid at a future date. Very important. In the event of bankruptcy, bondholders have a claim to the corporation's assets prior to that of stockholders. And we'll learn a little bit more about that in the next chapter about the difference in preferred and common stakeholders, or stockholders. But remember, if a corporation goes bankrupt, the bondholders, those that have bought bonds, are going to get part of the assets before you as a stockholder. So let's talk about the different types of corporate bonds. Most corporate bonds are considered debentures, and that's a bond that is backed only by the reputation of the issuing corporation. So, say for instance, you bought a bond from Coca-Cola. They have a pretty good reputation, but maybe somebody wants you to buy a bond from ABC Corporation that you've never heard of. That would be something you want to stay away from. Mortgage bonds, another name is a secured bonds, or corporate bonds, and they're secured by the assets of the issuing firm. They're the ones that are going to be more appealing to investor, but and then it goes back to where your rates are usually a little bit lower. A convertible bond can be exchanged at the owner's option for a specified number of shares of the corporation's common stock. And then finally, you have high yield bonds, and these are also called junk bonds. And they pay a lot higher interest than the rest of your bonds, but they have the higher risk of default. Today, most corporate bonds are callable. And when we say callable, a callable feature allows corporations to call in or buy outstanding bonds from the current bondholders before the maturity date. A corporation can use one of the two methods to make sure that it has sufficient funds to redeem an issue bond. First of all, they have what's called a sinking fund, and that's a fund which an annual or semi-annual deposits are made for the purpose of redeeming the bond issue. And then you have a serial issue, and that's a single issue that the bonds issue on different mature dates. Basically, investors, or you, purchase corporate bonds for three reasons: interest income, a possibility of increase in value, or repayment at maturity. Methods used to pay bondholders your interest depends on whether you own registered bonds or you have registered coupon bonds. Registered bonds are registered bond. Let me think of how I want to say that. Registered bonds are registered in the owner's name by the issuing company, while registered coupon bonds are registered for the principal only, but not for interest. Interest income is normally received every 6 months, or even until the bond's maturity, once every, might be once a year. And then they just kind of show you here where the what interest is calculated. So you have the amount of annual interest, and that's would be your face value times your interest rate. Increase in the value price of a bond can also be affected by physical conditions, physical financial conditions of the issuing corporations. In the time of a pandemic, the increase in value went down. So what that would be, that could be the supply and demand, or the upturn or downturn in the economy, kind of like I was just talking about, or even political uncertainty. So right here, it just kind of tells you about how they fluctuate with the change in the overall interest rate. And then when interest rates are increasing or decreasing, it's possible to approximate a bond's current market value, and that's how they tell you that you can figure that. In the above example, or the example below, the Heinz bond increased in value because the interest rate for the comparable bonds were lower than the 5.2% rate for the Heinz bond. So this just kind of shows you how you can approximate the market value of a bond. Okay, bond repayment at maturity, how that works. Corporate bonds, again, are repaid at maturity. When you purchase a bond, you have two options. You can keep the bond until maturity and then redeem it, or you may sell it, the bond, at any time to another investor. The value of your bond, again, is closely tied to the corporation's ability to pay the interest until maturity and then repay the bond's indebtedness at maturity. Now, a bond transaction. Most bonds are sold through full-service brokerage firms, Merrill Lynch, different things like that, discount brokerage firms that you can find, or even through the internet. Generally, if you purchase a $1,000 bond through a brokerage firm, you are going to pay a minimum commission of between $5 and $25. If you purchase more bonds, then the commission is usually going to drop. When you sell your bonds, you are actually going to have to pay a commission on the bonds that you sell. The last section we're going to talk about for bonds is, what about the decision to buy or sell bonds? The internet, of course, is a very valuable tool for a variety of purposes when you're looking at bonds. You can find many answers to relating to the financial strength of a company. And so when you're looking at investing in bonds, you can use the internet three ways. You can obtain pricing information, you can trade bonds online, and you can research a bond by accessing the bond's website. In bond quotation, prices are given as a percentage of the face value, and that's often by $1,000. So to find the actual current price of a bond, you must multiply the face value, which is, again, around $1,000, by the bond quotation. So this just shows you how you can find the bond quotation. So this one just is like at the time of this publication, the quote for a 4% Walmart bond that matures in April 2043 was 117. So you multiply that by the 1,000, and that is what the current price of that bond would be. Now, to find a bond's rating, these three, Moody's, Standard & Poor's, and Fitch Rating, are very important. You can find out all kinds of information about a bond and their ratings and their repayment and the maturity date, their interest rate. Everything you need to know is found in any of these websites. If you're considering buying bonds, I would highly suggest you choose one of these. Most people use Moody's or Standard & Poor's. Fitch Rating was a new one for me. And this slide just shows you how to calculate your current yield, showing you that you had bought McDonald's and at the time you bought it was 3.25, which you think you're making $32.50. But as the market goes up and down and you start looking at it, then the current yield is $3.07. So that's how much, or 3.07%. So that's kind of shows you what you're looking at when you're doing current yield. The final slide is a video that I found on should you buy bonds. That's just going to be a personal thing that you might want to do. I do like bonds because I'm a conservative investor, but you don't make as much money, but your money is pretty well secure. So take about 5 minutes and watch that video. I think you'll learn a lot. I thought the video was very, very interesting. So that ends our chapter 11 PowerPoint. I hope you feel a little more comfortable with investing in bonds now. And then now we're moving on to the stock market.